The beginner's course covered risk allocation, payment mechanisms, and financial close, the moment money starts moving and construction begins. But a PPP contract can run 25 to 30 years. Financial close only tells you who wrote the first check, not who's still holding the paper in year 20. That's institutional capital. Pension funds, insurers, sovereign wealth funds, infrastructure funds. This episode explains why they want that 30-year claim and how they decide whether to buy in. Here's why the fit is structural. Pension funds and insurers owe money decades out, managed through liability-driven investing, matching the duration of what they hold to what they owe. A toll road or availability payment hospital produces predictable, often inflation-linked cash for 25-plus years, close to the shape of a pension liability. Add an illiquidity premium and low correlation to public markets, and you get the case the OECD and G20 have built for over a decade. Infrastructure as its own asset class. Institutional investors rarely show up at financial close itself. That capital comes from construction phase lenders and equity, banks, specialist infrastructure funds, sometimes development finance institutions, built to underwrite construction risk. Overruns delay the asset never finishing. Once construction ends and cash flow turns contracted and de-risked, the return premium drops, exactly what long-duration capital wants. The position then gets refinanced or sold down. Bank debt replaced by long-dated bonds, pension funds, and insurers buying in. So how do they price it? A brownfield asset with contracted revenue, the kind Allianz Capital Partners holds for cash yield, not exit, might target under 10%. A greenfield project carrying construction or demand risk prices closer to the mid-teens. Canada's CPP Investments writes direct checks of hundreds of millions to over $1 billion Canadian dollars, taking controlling or significant minority stakes. Australian Super does the same, holding 32% of the UK's Peel ports directly. Smaller funds pool capital instead into vehicles like the UK's GLIL infrastructure, spanning 90-plus operational PPP and PFI assets. Here's what happens when that question gets answered badly. In 2006, a Sintra Macquarie consortium paid Indiana $3.8 billion for a 75-year lease on its toll road. They financed it with a 9-year interest-only bullet loan, hedged by a 20-year accreting interest rate swap, short, complex financing on a decades-long asset. When interest rates fell, the swap moved against them, and project debt nearly doubled to $6 billion. By September 2014, the concession company filed for bankruptcy. In March 2015, IFM Investors, an asset manager owned by pension and industry super funds, paid $5.7 billion for the concession, restructuring its debt into long-dated, non-callable bonds out to 40 years, matched to the asset's actual life. A year later, CalPERS bought a 10% stake directly from IFM, its first U.S. transportation investment. That's the chain: construction-era financing, a mismatch that broke it, and institutional capital arriving once the financing fit the asset. So here's the through line. Institutional investors hold long-duration, inflation-linked cash flow because it matches what they owe. They typically enter after construction risk is gone, through refinancing or a sale down from the banks, and in for funds that carried the project through construction. They price what they buy by risk profile: brownfield and contracted cheaper, greenfield and demand-exposed more expensive. Indiana's toll road shows the cost of getting the financing tenor wrong, and what institutional capital adds once it's matched correctly. That's PPP Deep Dive. Institutional investors, subscribe to follow the series.